Hey there, welcome to our video about the 2008 stock market crash. In this video, we'll dive deep into what caused the crash, how it may happen again, and what could have been done to prevent it. The 2008 stock market crash was caused by a combination of factors, including the housing bubble, the excessive risk-taking behavior of financial institutions, and the lack of regulation in the financial industry. The housing bubble was created when housing prices increased rapidly due to easy access to credit and low interest rates. This led to an increase in demand for housing, which in turn led to an increase in housing prices. Homeowners began to take out mortgages that they couldn't afford, which led to a high number of defaults on these mortgages. This caused the housing bubble to burst, resulting in a decrease in housing prices and a high number of foreclosures. Another significant factor that contributed to the 2008 stock market crash was the excessive risk-taking behavior of financial institutions, specifically investment banks. These banks were able to create and sell complex financial instruments, such as mortgage-backed securities, which were essentially bundles of mortgages that were sold to investors as a way to spread out the risk. However, many of these mortgages were subprime, meaning they were given to borrowers with poor credit histories who were at high risk of defaulting. Despite this, the investment banks continued to package and sell these securities to investors, ultimately creating a housing bubble. When the housing market began to collapse and homeowners started defaulting on their mortgages, these securities lost their value and the banks holding them suffered huge losses. This led to a crisis of confidence in the financial system, as investors became afraid that other financial institutions would also suffer losses. The lack of regulation in the financial industry also played a significant role in the 2008 stock market crash. The deregulation of the financial industry in the 1980s and 1990s led to the creation of complex financial instruments and the growth of financial institutions that were too big to fail. As a result, many financial institutions took on excessive risks, which ultimately led to their downfall. This lack of regulation also meant that the government had little oversight over the financial industry, which made it difficult to prevent the crisis from happening. So, how could this happen again? Well, there are several warning signs that we should be aware of. One warning sign is the high levels of corporate debt that have been accumulated since the 2008 financial crisis. Many companies have taken on excessive debt to fund their growth, which could lead to a crisis if these companies start to default on their debt. Another warning sign is the lack of regulation in the financial industry. While some regulations have been put in place since the 2008 financial crisis, there are still concerns about the growth of complex financial instruments and the lack of oversight over financial institutions. Finally, there is the risk of another housing bubble. While the housing market has recovered since the 2008 financial crisis, there are concerns about the high levels of housing prices and the increase in subprime lending. So, what could have been done to prevent the 2008 stock market crash? Well, one solution would have been to regulate the financial industry more effectively. This could have included putting limits on the amount of debt that financial institutions could take on and increasing oversight over complex financial instruments. Another solution would have been to prevent the housing bubble from forming in the first place. This could have been done by implementing stricter lending standards and making it more difficult for homeowners to take out mortgages that they couldn't afford. In conclusion, the 2008 stock market crash was caused by a combination of factors, including the housing bubble, the excessive risk as the housing market began to decline, the impact spread to other areas of the economy. One such area was the mortgage industry. Many mortgage lenders had made risky loans to people who didn't have the credit history or financial means to repay them. These loans, known as subprime mortgages, were bundled together with other loans and sold to investors in the form of mortgage-backed securities. The problem with this was that the risk of default on these subprime mortgages was much higher than on traditional mortgages. When homeowners began defaulting on their loans, the value of the mortgage-backed securities plummeted, and many investors suffered massive losses. This loss of confidence in the mortgage-backed securities market then spread to other financial markets, such as the stock market. Banks and other financial institutions had invested heavily in these securities, and as their value declined, so did the value of their assets. This left many banks and financial institutions in a precarious financial position. As the crisis deepened, more and more financial institutions began to fail or were on the brink of failure. This created a ripple effect throughout the economy, causing widespread panic and a freezing of credit markets. With credit markets frozen, businesses were unable to obtain the funding they needed to operate, and many were forced to close their doors, leading to widespread job losses. So, now that we know what caused the 2008 stock market crash, let's talk about how it could happen again. While the global economy has recovered significantly since 2008, many experts are warning that another crash could be on the horizon. One of the main concerns is the level of debt held by individuals and businesses. The subprime mortgage crisis was fueled, in part, by high levels of debt among homeowners who were unable to keep up with their mortgage payments. Today, we are seeing similarly high levels of debt among both individuals and businesses, which could lead to another crisis if defaults begin to occur. Another concern is the potential for a trade war or geopolitical tensions to disrupt global markets. With tensions rising between major economies such as the US and China, there is a risk that protectionist policies could be implemented, leading to a reduction in trade and a subsequent drop in the value of global stocks. So, what could be done to prevent another crisis? One of the key lessons learned from the 2008 crash is the importance of regulation. In the aftermath of the crisis, governments around the world implemented new regulations aimed at reducing risk in the financial system. These regulations include stricter requirements for banks and other financial institutions to hold capital reserves, as well as increased oversight by regulatory bodies. While these regulations have been effective in reducing risk in the financial system, there are concerns that they may be rolled back in the coming years, which could increase the risk of another crisis. Another potential solution is to encourage greater transparency in the financial system. One of the problems leading up to the 2008 crisis was a lack of transparency around the risks associated with subprime mortgages and other complex financial products. By increasing transparency, investors and regulators can more accurately assess the risk of different financial products and take action to reduce risk where necessary. Overall, the 2008 stock market crash was a devastating event that had a significant impact on the global economy. While we have made progress in recovering from the crisis, there is still a risk that another crash could occur in the future. By understanding the causes of the 2008 crisis and taking steps to prevent a similar event from happening again, we can help to safeguard our financial system and ensure greater stability for our economy.